financial accounting, we're answering the question, how did you do? So we're preparing financial statements primarily with outsiders in mind to tell them how we performed. The four financial statements we prepare are the income statement. That's our report card for a period of time. Did we make money or did we lose money? The statement of retained earnings, which is the heart of the statement of shareholders' equity. It tells the outsiders what we did with our earnings. Did we retain them in the company or did we pay them out to our shareholders in the form of dividends? The balance sheet, what we own versus what we owe, and the difference between what we own and what we owe is our equity in the business. Finally, the statement of cash flows explains to the outside world what happened to our cash balance over the course of the last period. And the first three of these, the income statement, the statement of retained earnings, and the balance sheet, are a product of the accounting cycle. The accounting cycle is a multi-step process whereby we record our transactions, prepare our financial statements, close out our books at the end of the period, and start all over again. Let's look at some transactions and walk through the first four steps of the accounting cycle. On September 1st, company sells common stock for $15,000. Analyze the transaction. Is there something that can be reliably measured in dollars? Yes, we sold some stock for $15,000. Step 2, let's journalize the transaction. Let's record the transaction using debits and credits. Debit means left, credit means right. Our other rules are that journal entries always balance. The dollar amounts of the debits always equal the dollar amounts of the credits. Assets increase with debits. That's easy to remember because they're on the left-hand side of the balance sheet and debit means left. Liabilities and shareholders' equity accounts increase with credits. That's easy to remember because they're on the right-hand side of the balance sheet, and credit means right. Expenses are debits, expenses are debits, expenses are debits. Revenue accounts, like sales or consulting revenue, those increase with credits. That's easy to remember because expenses are debits and revenue is the opposite of expenses, so they must increase with credits. And dividends start with D, which remind us that they're recorded with debits. Back to our transaction. The company sells common stock for $15,000. What's happening to cash? Cash is going up. Cash is an asset. Assets increase with debits. So we debit cash for $15,000. Common stock is an equity account. It increases with credits. So we credit common stock for $15,000. One of the biggest mistakes beginning students make is they use phrases and sentences up here when we should use account titles. For example, we don't debit cash from sale of stock. We debit cash. If you want to write a sentence, please put that down here in the memo section to remind ourselves and the next user exactly what just happened. The next transaction is on September 2nd. The company buys equipment for $14,000, putting $8,000 down and the balance on account. When we're paying for something on account, that means an account payable. What's happening to equipment? Equipment is an asset. Assets are things that we own that are going to provide us with future benefits. Assets increase with debits, so we're going to debit equipment for $14,000. What's happening to cash? Cash is going down. If assets increase with debits, they must decrease with credits. Every journal entry has to balance, so that means we need a $6,000 credit. Any account that has the word payable, accrued, or unearned in it is a liability account, like accounts payable. Liability accounts increase with credits, so we credit accounts payable for $6,000. On September 3rd, the company's paid $7,000 for consulting services performed. What's happening to cash? Cash is going up. Cash is an asset, increases with debit. So we write the debit first, and then we've got some revenue earned. If expenses are debits, expenses are debits, expenses are debits, the opposite of expenses, revenue or sales, must increase with credits. So we'll skip down a line, indent a little bit, and write the credit. I'm going to put the revenue account, could have been called consulting revenue, this time we called it service revenue. I'm going to put it in a red font so that we can get in our minds the distinction between balance sheet accounts and income statement accounts. Then for our last transaction, on September 4th, the company pays rent of $1,000. Why don't you see if you can pause this video and create that journal entry? I hope you got it. Expenses are debits, expenses are debits, expenses are debits. So we debit rent expense. Come down a line, indent a little, write the credit. What's happening to cash? It's going down. Cash is an asset. It increases with debits and decreases with credits. So we credit cash for $1,000. Now my boss walks in and she wants to know how much cash we have. She wants to know what the balance is in accounts payable. Well, I've got all our transactions, but they're in chronological order. We want to reorganize the data by account. So we'll perform step 3 of the accounting cycle and post them to their individual ledger accounts. And in the world of accounting, we often use T accounts to symbolize those individual ledger accounts. The T account has the name of the account at the top. The left-hand side represents the debits, and the right-hand side represents the credits. We offset all the debits against all the credits to strike a balance. Let's post this first transaction. Cash got a debit of $15,000, and common stock got a credit of $15,000. Let's post the next transaction. Equipment got a debit of $14,000, and cash and accounts payable got credits of $8,000 and $6,000 respectively. We're going to be kind of fancy and put the dates out here next to these transactions. We don't always do that in the real world. All right, and then we'll post the rest to their accounts. And I kept up my convention of putting the income statement accounts in red font, again, to help us remember that an account appears either on the balance sheet or the income statement, not both. And we still can't quite answer the question, how much cash do we have? We have to add up all the debits, subtract all the credits, and strike a balance. Cash went up by 15, went up by 7, went down by 8, went down by 1, so that gives us a $13,000 balance in cash. We draw a line in the T account and write the balance on the correct side. In this case, cash is an asset, so it has a debit balance. If we'd struck a balance in the service revenue account, it would have a credit balance, and we would write it on the right-hand side. But since there's no arithmetic to be done, it isn't really necessary for us to strike a balance. Let's do step 4 of the accounting cycle, which is to create a trial balance. Name of the company at the top, title of the financial statement, the date, this is as of September 4th, and this is really important. We have to list the accounts in the special order: assets, liabilities, owner's equity, revenue, and expenses. One of the biggest mistakes students make is they list these accounts in a random order. We need to have these in that special order because we're going to use the adjusted version of this to create our financial statements by starting at the bottom with our income statement accounts. All right, so all we have to do is post the balances into the trial balance. The balance in the cash account is $13,000, the balance on equipment is $14,000, etc. And I've also kept with the convention of writing the income statement accounts in red font to remind us that an account appears either on the balance sheet or the income statement, not both. And the other big mistake that beginning students often make is they'll write $22,000 here and they'll write $9,000 here next to cash. We put the balance of each account into the trial balance. All our debits equal all our credits, so we're very much on the right track.